I just watched a video from a woman who retired at 59 with $500,000. And look, I respect her honesty. She laid out the four risks that could break her plan: baseline creep, market downturns, health costs, living too long. But here's the part that stopped me cold. Her entire strategy for surviving retirement: monitor everything, trim spending, take smaller trips, skip upgrades, watch your income like a hawk, adjust, adjust, adjust. And I just sat there thinking, is this really what we're calling retirement? Because what she described isn't freedom, it's financial surveillance for the rest of your life. And I want to show you why there's a completely different way to think about this. Let's start with what she's got right. 500,000 is not a lot of money to retire on. Now, she knows that. The financial advisors, they know that, and you probably know that too. But here's what's keeping everyone wrong. The conversation is always about how to manage $500,000, how to stretch it, how to make it last, how to squeeze 25 or 30 years out of a pile of money that frankly wasn't that big to begin with. Nobody asked the obvious question: what if 500,000 didn't have to be the final number? She mentioned that an extra $800 a month in rent could cost her $200,000 over 20 years. And she's right. That math checks out. But the flip of that lens is, what if instead of obsessing over every $800 going out, you focused on building something that puts 800 or 2,000 or 5,000 a month coming in? That changes everything. Not because the risks disappear, but because you're no longer playing defense with a shrinking pile of money. You're playing offense with a growing one. And here's what concerns me about the whole be careful, monitor everything approach. It works for a while. When you're 59 and you're healthy, energized, freshly retired, well, sure, you can track every dollar. You can use spreadsheets. You can say no to the nicer apartment. But what about at age 72 or 78? Do you really want to be 80 years old, still watching your withdrawal rate like a hawk, still asking yourself, can I afford this trip to see my grandkids? That's not a retirement plan. That's a 30-year anxiety sentence with a spreadsheet. And I'm not criticizing her. She's doing the best she can with the tools that she was given. The real problem is the tools. Traditional finance planning gives you exactly two levers: save more, spend less. That's it. That's the whole playbook. So when you retire with 500,000, the only advice anyone has is be really, really careful with it. Don't spend too much, don't live too well, don't get sick, and don't live too long. Think about that last one for a second. One of her four risks is actually living too long. Longevity is a risk in this model. When living a long, full life becomes a threat to your financial plan is broken, not your life. So what's the actual answer? It's not about being more disciplined. It's not about cutting back harder. It's about choosing the right vehicle. Let me explain what I mean. If you put $500,000 in a traditional portfolio, index funds, bonds, maybe some dividend stocks, you're looking at historical rates of return of maybe 7 to 8% per year. That's on the high end. After inflation, well, let's call it 4 to 5%. And you're pulling money out of that every single month to live on. So you're earning 4 to 5% and withdrawing 4%. That leaves you basically treading water. No wonder every financial planner says, be careful, there's no margin, there's no room to breathe. One bad sequence of returns and you're done. Now imagine a different vehicle entirely. What if a portion of that 500,000, not all of it, but a strategic portion was allocated to an asset class that has averaged 50, 100, even 150% annual returns over the past decade? I'm talking about digital assets, specifically Bitcoin and the broader crypto ecosystem. Now, before you click away, I'm not talking about gambling on meme coins. I'm not talking about day trading. I'm talking about a calculated strategic allocation to the single best performing asset class of the last 15 years. If you'd put just $50,000, 10% of that 500,000K, into Bitcoin 5 years ago, that $50,000 would be worth roughly $500,000 today, all by itself. You wouldn't need to worry about an extra $800 a month in rent. You wouldn't need to take smaller trips. You wouldn't need to watch your healthcare subsidies like a hawk, because the vehicle did the work, not your willpower, not your ability to sacrifice. Now, I already know what some of you are thinking. Well, that's risky. That's volatile. That's not what responsible people do. And I get it. That's what you've been told. But let me ask you something. What's actually riskier? Option A, put everything in a traditional investment, earn barely enough to keep up with inflation, and spend 30 years monitoring every single dollar, hoping you don't run out before you die. Or option B, keep your core expenses covered with safe money, cash reserve, Social Security, well, that's the boring stuff, and then allocate a strategic portion to the highest growth asset class in modern history, one that institutional investors, sovereign wealth funds, and the biggest companies on earth are now piling into. The first option feels safe, but it's actually terrifying when you look at it honestly. You're betting your entire future on everything going perfectly for 3 decades. No major health events, no surprise expenses, no policy changes, no inflation spikes, and most importantly, no desire to actually live a little. The second option has volatility. Yes, Bitcoin drops 30% sometimes. It dropped 80% before, but it has always recovered every single time and gone to make new highs. Every single time. You know what doesn't recover? The 3 years you spent saying no to life because your financial plan required you to think small. So here's what I'd tell anyone sitting on $500,000 right now, wondering if it's enough. Stop asking, is it enough? Start asking, what's the right vehicle? All right, so here's some steps. Step 1, cover your bases. Keep 1 to 2 years of expenses in cash. Make sure your immediate needs are handled. This part she nailed. Cash cushion is smart. No argument there. Step 2, stop putting all your growth money into the same underperforming vehicles that got you here. If traditional investing was going to make you wealthy, it would have done so by now. You've been in this market for 20 to 30 years. Where has it gotten you? $500,000. That's the proof that the vehicle isn't working. Not that you aren't working hard enough. Step 3, educate yourself on digital assets. Not from the headlines, not from the fear-based news coverage, but from people who actually understand the technology, the cycles, and the long-term trajectory. Step 4, make a strategic allocation. Not your whole portfolio, a meaningful percentage that gives you genuine upside potential. Even 10 to 20% in the right assets can transform your retirement outlook from hopefully I don't run out to I have more than enough. And step 5, stop making don't live too long part of your financial plan. Look, I have nothing against the woman in this video. She's brave for sharing her numbers. She's honest about her risks, and she's doing the absolute best that she can do with the strategy she was taught. But that's the point. She was taught a strategy built for a different era. A strategy that says the best you can hope for with $500,000 is to live cautiously, nervously, anxiously, and stretch it across 30 years. I believe there's a better way. A way where you don't have to treat your own longevity as a risk factor, where you don't have to choose between seeing your grandkids and keeping your withdrawal rate in check. You don't need a bigger pile of money. You need a better vehicle. Now, if that message resonates with you, hit subscribe. I'm going to keep showing you exactly how this works with real numbers, real strategies, and zero financial jargon. And also drop a comment below. I want to know, are you managing scarcity right now? Or are you ready to start building? I'll see you in the next one.